Hello and welcome to the first episode of The Index Investor, a series where we address the most frequently asked questions from our viewers about index funds. Now, joining us today to answer these queries is Arun Sundaresan. He's head of ETF at Nippon India Mutual Fund. So stay tuned as we kick off the series by busting some myths and breaking down the basics of index investing. Welcome, Mr. Sundaresan.
Thank you, Ruchira. Thanks for having me on the show.
Great to have you here. Now, while the surge in popularity of index funds, it seems recent, but the idea has surely been around for decades. So let's begin today's episode with a top of the mind question. Why are index funds suddenly everywhere? What has changed? Investor mindset, market cycles, fund accessibility, or what is it?
Okay, so index investing is part of passive investing. So there are two forms, index and ETFs, the exchange traded fund. So we can use that interchangeably, and the concept is same. So this concept actually is quite old, like you pointed out. In the world, the first ETFs, exchange traded funds, got launched in the 1970s by the legendary Mr. John Bogle. And since then, they've come a very, very long way. The assets under management globally, in fact, the passive assets under management is even higher than the active funds globally, particularly in the US and some of the other parts of the developed world. India, it has picked up, but only in the recent past, I would say. Although the first index ETF funds got launched even in India way back in 2000. So we have almost 2020, 25-year kind of a history, right? But the assets under management, the AUM movement, the number of investors, all of these things are happening, particularly, I would say, in the last 5 years. So maybe I don't know if it has got anything to do with COVID. And then what happened, post that there was a surge in the number of demat accounts. Maybe a lot of investors started experimenting with their investments themselves, do it yourself kind of investors came in and stuff like that. Maybe, that kind of accelerated. But having said that, there are a lot of advantages to passive investing, which I think with increasing awareness levels, the accessibility to invest, people are able to conveniently invest through various digital modes these days, much better than how it was 10 or 15 years back, and a host of other advantages that passive funds index investing per se offer. I think all of these things are catching the fancy of investors. Today, both these formats put together, the assets under management in India is roughly about 12 lakh crore. That's approximately 17% of the overall mutual fund assets. So not a small size either. And in terms of the number of folios or number of investors, we have 4 crore. But again, more importantly, as I said, the concept has been picking up in the last 5 years. 5 years back, for example, the index AUM was just about 8,000 crore. Today, that is about 3 lakh crore. And in index format alone, we have something like 1.3 crore folios. But this is a place which is also growing very fast. In fact, in the last 5 years, the cumulative, the CAGR growth, both in terms of AUM and in terms of folio, has been in excess of 100% compounded every year. That's the kind of growth that we are witnessing in the recent past.
Yeah. So next, let's dive into one of the biggest debates in investing, passive versus active. So is it true that most active funds underperform over the long run, or what does the Indian data say? And how should this influence a young investor's choice for their first fund as such?
Okay, so passive investments, I think our readers or investors will understand this. So you're simply replicating the index or the market, right? So essentially what you're saying is that, look, equity market itself can give me good returns. Let me go and capture that. It could be through large cap, it can be multi-cap, or it can be, let's say, a specific sector or a theme. I just want to capture that. Suppose I like bank, I go and buy a bank index fund. Within that, I do not want to figure out which bank to buy more, less, etc. And that's where the active part comes in, right? So essentially, you're saying that look, the market return itself is very, very attractive, and that's the case for India, right? Over a period of time, the returns have been fabulous. So someone with that kind of a mindset, saying that I am here to capture the market return. I do not want to take more risk than that in the hope that I could get higher returns. So that's the kind of mindset. And Obviously, there is a lot of empirical evidence, data. Globally, this concept has been around for a very long time. Even in India, the investing is a popular phenomenon. It's been around for a very long time. And there are a lot of big data firms which analyze, which do research, and they do put out a lot of data points. So one such firm is called, and this report is quite famous. It's called SPIVA report, S&P Index versus Active. That's the full form for the acronym
Mhm.
SPIVA. So they do this analysis for different markets, for US markets, for China, for India. So what they do is every 6 months, they look at a lot of data points of different funds and compare how these funds, the active funds, have performed against market or index per se. And what is coming out is that even for India, the as per the Spiver report, and they do this for in equity three categories: the large cap, the tax saver, the ELSs, and mid and small cap categories, for three categories. In fact, the data stock most funds, in fact, almost 70 to 80% of the funds are actually underperforming the benchmark.
Mhm.
This report is available in the public domain. Somebody wants to Google and check that, they can check that out. All the details in terms of 1 year return, 3 year return, 5 year return. So the data does suggest that a lot of funds are indeed underperforming. Therefore, when you combine this with the fact that why do I have to pay higher cost to identify a fund which can potentially outperform, then it becomes even more a challenge. Therefore, should I not restrict myself? Should I just not go and take the market return and not take any further risk than that? And in a way, if you look at it, the IPL just got over, right? So in some ways, you can relate. A team which is, let's say, the team which won the IPL trophy last year, that team may not even sometimes qualify. Sometimes, end up finishing in the last, ninth place or the 10th place. So not only there can be times where it could underperform and stuff, consistently outperforming also is a challenge. You
Hmm.
think that a fund is doing well now, and then go behind that, the fund could underperform in the next year, and it keeps repeating time and time out. Therefore, why break my head with all these things? Why should I take the risk of underperformance, which is large and stark right in front of you, and it may not be worth it? And that's the kind of mindset that at least passive investors have.
Right. So, what is your view? How should one decide what should be their first fund, active or passive?
So, Ruchira, I generally would not get into this conversation of it should not be active versus passive. Okay.
Mhm.
It can actually coexist, as in, like, there are certain strategies in passive which are not even available in active, and
Hmm.
vice versa, right? There are, for example, smart beta index funds or factor based funds. Like, for example, it can even be two factors like alpha and low volatility combined, right? Or a specific factor like momentum, value. So, likewise, there are a lot of interesting strategies in the passive. This is on equity. On fixed income, you have what we call as target maturity funds, TMF, which are almost like FDs. Like, for example, today we are in 2025, and you want to consider something like a 3 year investment horizon in a fixed income fund. You have a fund which will mature in 2028. So you simply buy that fund and hold till 2028. And whatever is the return from here on, given the current yield, more or less you can look forward to getting that yield. So it works almost similar to fixed deposits, right? with additional liquidity that if you want at any point in time, you can take out that money. So these kind of funds are available only in the passive. It is not available in the active format. Likewise, in the active, for example, there is this category called as hybrid, equity hybrid. You have arbitrage and a whole lot of different variants, which is not available. So a lot of times, these funds can complement each other. It can add value to your portfolio overall, right? So therefore I think for investors the starting point should never be should it be active or passive. Rather they'd be better off if they look at the strategy independently. Like for example, I look at this particular, let's say this is a strategy fund. Let's say it's called a momentum fund. What exactly is it doing? It's replicating a momentum index, and how does it do, and how is historically it is performed. You will have whole of lot of those data to peruse, and then you can take a considerate call basis that. So my recommendation would be not to have the starting point as active versus passive. Rather, look at your own individual requirements and then look at various strategies and how they fit in to your requirement. That will be the best way to go about it.
Fair enough. But then, there is this question that comes up time and again, that passive funds, they don't have star fund managers or aggressive strategies. So how can they still be powerful wealth builders? What do you have to say to that?
Okay, so this is related to the earlier point that we just discussed, that quite likely that many funds, including some of the star funds, which could be performing at some point in time, may not perform in the next year or in the next year. So that kind of cyclicality could be there, which means that these funds potentially could underperform from time to time, and it's very difficult to also preempt and figure out, right? So this becomes an additional layer of risk and return for you, right? So one is you're getting into, let's say, a mid cap fund. Okay, so the choices for you is one, select a mid cap index. The mid cap index itself can give you market return and relatively speaking more relatively aggressive market return when compared to large caps. Right now, over and above that, if you're trying to figure out a particular fund, a good mid cap fund or a couple of good mid cap funds, you may get it right sometime, you may not get it right sometime. So therefore, would you really want to take that additional element of a risk in the hope of getting additional return? That's something that investors will have to think hard, and obviously it will come at a relatively higher cost as well, right? So that's how things work. So star fund manager not necessarily would generate better returns and do that consistently, and that's what data suggests time and time out. On the other hand, the index is devoid of that. On the other hand, you're betting on the market, and that's it, nothing more, nothing less.
Right. So, one last question for today. Is passive investing truly foolproof, or are there some traps that one should watch out for?
See, a lot of investors, I mean, when they interact with us, they ask us this saying, they sometimes perceive passive as less risky
Yeah.
than, active. For example, active is generally associated with alpha and therefore, additional return and stuff. So they think that passive is subordinated. They think passive is boring. They think, this has less risk than active. But that's not the case at all, right? Now, within passives, there are a lot of variants, and depending on the strategy, you will have the underlying risk. For example, we talked about mid cap. A mid cap index fund will have as much risk as the mid cap market,
Hmm.
right? So, on the other hand, if you really think about it, passive fund will be fully invested at any point in time. So if you're selecting a mid cap fund or a small cap fund, it will be 100% invested into that category at any point in time, now and forever in the future. So there is no concept of that getting diversified with some bit of large cap or some bit of, some other defensive or, sometimes cash calls. So you don't have at least those theoretical safety nets. So it's going to be fully invested at all points in time. if you look at it from that perspective, actually it's quite relatively higher on the risk and return. So even if something temporarily were to go wrong, there is no fund manager to course correct or take any corrective action. Those things are not going to happen. So you're going to stay invested. The control will be with you. So as an investor, it's upon you whether you want to take cash call or you want to stay invested for the longer term. This particular passive fund, in this case, if it's a mid cap or a small cap, or for that matter, if it is a sector or a thematic fund, investing into a specific niche sector, for example, a realty index fund. If the real estate sector goes through a slight phase of trouble, or that fund will undergo a downside, right? So investors will have to be aware of that. Index fund is not about less risk or that it is subordinated. In fact, there are very very interesting options there, and some of them can be extremely high on risk and return. Even within equity, in relative sense, they can be extremely high on that. Quite the contrary to being boring.
Well, that wraps up today's episode of The Index Investor. Thank you, Mr. Sundaresan, for sharing such valuable insights.
Thank you, Ruchira. Pleasure talking to you.
Thank you. Be sure to join us for the next episode going live on 26th of June, where we'll explore how to build a portfolio with index funds. See you then.